Good morning, everyone. Thank you for joining us this morning. This is the Tariff Financial Partner webinar series in March, and we're going to be talking tariffs and general market update and portfolio update with Anna Tabke and Brett Alford with Alpha Asset Management. The presentation is going to go for about 30 minutes with time for Q&A at the end. Well, yeah, so please hold your questions at the end, and please stay on mute during the presentation, and then at the end, I will unmute for questions. The chat is disabled for compliance purposes, so we'll just unmute our mics to ask the questions when the time comes. I'll turn it over to Mike for introductions.
Great, Charlie. Thank you very much. Good morning, everybody. Just wanted to touch base a little bit about Alpha Capital Management on our portfolios, and I'm sure everyone is concerned about the tariffs and the potential impact on the economy and portfolios and other fiscal policies that are being debated and implemented as we go with the new administration. So thank you for joining us today for that conversation. Give you a little bit of introduction to Alpha Capital. We consult with Alpha Capital about portfolio construction, asset allocation, and mutual fund and ETF management and research. Our partnership with Alpha Capital has led to our implementation of the Tariff Financial Customized Alpha portfolios, which are designed to bring risk-aware and a smoother investment performance and experience for our long-term investors. A little bit about Brad and Anna. Brad is a CFA, Chartered Financial Analyst. He is the founder of Alpha Capital Management, founding the firm back in July of 2006. With over 35 years of investment management experience, he directs the firm's outsourced chief investment officer and consultant search services, along with the creation and management of multiple NASDAQ OCIO indices to advance transparency in that industry. He holds the BS in corporate finance and an MBA from the University of Alabama. Roll Tide, we won't hold that against him, right, Georgia fans? And he's completed the intensive senior investment manager program at Princeton University and is a chartered financial analyst, charter holder, and member of the CFA Institute. He currently serves on the finance and investment committees of the Marist School and the Atlanta Ronald McDonald House Charities, and prior to founding Alpha Capital, served in various management and directorships at Atlantic Trust, my CFO, the Duke University Endowment, and the Emory University Endowment, along with creating and selling IPOlookup.com way back in 1999 and 2000. Anna Tabke is also a CFA. She joined Alpha Capital Management in 2012 as a principal, matching institutions with investment consultants or outsourced chief investment officers. With over 20 years experience, she also leads the firm's intellectual capital creation, producing thought leadership on the OCIO industry and writing research papers, as well as heading investment committee governance education. She earned the BA in economics from Princeton University. She is also a CFA charter holder and a member of the CFA Institute, and is a chartered alternative investment analyst. She serves as the chair of the board of directors at Woodlands Garden in Decatur, as well as investment committee member and board member of the Atlanta Society of Finance and Investment Professionals. Prior to joining Alpha Capital, she was an investment consultant at Mercer and Rogers Casey and is often quoted in the financial press. So just wanted y'all to know a little bit about Brad and Anna and our relationship with them and with Tariff Financial and how they assist us with building our portfolios. And with that, we're going to turn the program over to Brad and Anna. Start off by telling us a little bit more about Alpha Capital and what y'all do. And let's then talk tariffs. Thanks.
Sounds great. Well, good morning, everyone. Thanks for being here with us. So Brad and I are the principals of Alpha Capital. As Mike said, we've worked with him and Charlie for a long time doing portfolio construction and investment advisory work. So we're excited to be here this morning. Happy to answer any questions that you have. And we're excited to talk about tariffs.
Great. Good morning. I'm sorry I'm a little bit sick today, so voice is kind of coming in and out, but glad you guys could get going early this morning, and we're excited about talking about the markets, tariffs, what we do, the portfolio, and how we work with Mike and his team and Charlie. Great. So going into the first page, talked about our backgrounds, but the way we run the portfolios is very institutional-like. Started my career here in Atlanta at Emory University's endowment, and then went to the Duke Endowment, North Carolina. And at those institutions, we run a very consistent portfolio, don't hire and fire managers on a whim, and really try to stay with managers for 3 to 5 years. And we'll switch managers in out as if they begin to change their strategy or they have personnel leave that are important to the portfolio. But we're really trying to, run an institutional portfolio within, clients like you. On the next page is go through that. We talked about, Anna and I are both CFA, so we've been around the block. I've been around the block a little bit more than her, but about 35 years experience.
All right, well, let's talk about tariffs. So one of the first things we want to address is what actually is a tariff. So a tariff is very simply, it's a tax on imported goods. One of the things that we see people often misunderstand is who actually pays this tariff, right? So when we hear about it in the press, we think, okay, we're going to start charging China to sell to US consumers. It's actually not true. We are the ones that really ultimately pay the tariff. So this tax is paid by the importers of the goods into the United States. So if you order something on Amazon and it comes from China, whoever it is that imports it into the US, usually some sort of a US company, is the one that ultimately pays that tax or that tariff. So what happens then? Often those tariffs are passed on in increased wages, increased costs, increased all of these business things that have to go on to pay for these, lower margins. They pass them on to the consumers. So ultimately, the ones that are paying these tariffs and these tariff wars are the US consumers. There are a handful of notable exceptions. Chipotle has come out and said, even though they get most of their avocados from Mexico and we're looking at tariffs there, they are not going to pass those costs on to consumers. But as we all understand, most of these businesses are going to have to as they're facing higher costs for their products. So the obvious question is, if we're the ones paying the tariffs, then why are we going to do this? So there's a couple of commonly used arguments for tariffs. The first one is to reduce the trade deficit. So I've got the trade deficits here, and you can see that our trade deficit with China is huge, right? So this is 2023 numbers, and when the numbers are below on this axis, it means that we are buying a lot more from China than they are buying from us, with a net negative $279 billion a year. The next one is Mexico, so they're in the crossfire. Vietnam is the third one, and we're going to talk about why that is. But one of the goals of tariffs is to get people to stop buying things from China so that this number equalizes or normalizes and gets closer to the zero line. So that's one argument. Another argument is that our domestic companies cannot compete with low-cost manufacturing from China. And so by increasing the prices for the goods that are imported from China, you get them closer to where the goods prices are for those that we make in the US, and that helps us to be more competitive. So you'll see this a lot with things like steel. That's true. And then the third option that we often see is, they call it a tariff war for a reason, right? It's a retaliation. Tariffs are one of the tools that all these countries are using to manage the global balance of trade. And if other people are putting tariffs on us, we might retaliate and put tariffs on them. And if we are the ones that are coming out with a big stance on, we're going to put tariffs on people, they're probably going to retaliate against us. So those are some of the commonly used arguments for tariffs. But I'm an economist by training, and I can tell you that tariffs tend to be very unpopular with economists. As you might imagine, we tend to be pro-trade people, and really, tariffs are kind of getting in the way of that. And so I thought David Kelly, who is the chief global strategist at JP Morgan, had a really great quote on this that sums up why economists don't like it. So the trouble with tariffs, they raise prices, they slow economic growth, they cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're fine. So it pretty much sums it up. So as we talked about, the trade balance with China is really bad. So why is Vietnam the third? Well, we've been here before, right? So the last time Trump was in office, we had kind of a tariff wars. We put a lot of tariffs on China. And you can see that on this chart here. So this is 2010 and this is 2020. The purple are the tariff rates on China, and the gray is on basically everyone else. So you can see that we have significantly increased our tariffs on China, and it's not just this year. As a result of that, a lot of the US companies that were manufacturing things in China shifted their supply chains to other areas in Southeast Asia. We call this friendshoring. So Vietnam is a friendly country to the United States. And that's why you've seen countries like Vietnam have a larger trade deficit because they're actually absorbing some of that from China. And we might see that start to happen again. So tariffs cause a lot of downstream effects, right? So one is the supply chain disruptions that I just mentioned. If we start having tariffs from certain countries, the impetus is to move your supply chains to other countries where you're not going to be subject to those tariffs. So that's one of the main ways that we see this being disruptive. Global trade retaliation, right? We talked about that too. If we start putting tariffs on European cars, they're going to put tariffs on our cars. It's reducing the likelihood that those other countries are going to buy our goods too when this starts being retaliatory, right? If you think about all the reasons we just talked about that we want to put tariffs on China, we're making their goods more expensive, so people want to buy ours. In a retaliatory environment, the opposite is going to be true, right? In Europe, they put tariffs on our cars. Our cars are going to be more expensive. People are going to want to buy the homegrown thing. So that's one of the reasons why economists don't like tariffs. It's never really a one-way street, and it's going to reduce our ability to export goods to other countries. It can affect currency. We all know the US dollar has been really strong. In the short term, tariffs typically will probably strengthen the US dollar, but over the long term, that's a lot more questionable. And it really just has to do with how many foreign goods versus domestic goods are we all buying relative to each other. So, if we are exchanging US dollars for foreign currencies, it depends on how many dollars are going which way, which is going to do supply and demand and either help or depress prices. So in the short term, it looks good for the US dollar. Markets hate uncertainty. And so the US dollar is also still a safe haven. So that tends to be a good sign for the US dollar. But again, over the medium term, it really just depends on how all of these kind of tariffs and counter tariffs work out together. Inflation, this is another big one that a lot of people are worried about, right? So we are essentially raising costs for our consumers. That's inflationary. You saw yesterday, the Federal Reserve indicated that they expect inflation to be about 2.7% this year, up from 2.5%. And a lot of that is a concern about these tariffs. However, tariffs are also tricky in the medium term because remember what we talked about, economists don't like them, they slow growth. So if you get raising prices and slowing growth, now you get stagflation. And that is what a lot of the economists are worried about. Short term, it may be inflationary, but in the medium term, you're risking stagflation. If you put all this together, there's obviously a lot of uncertainty. And as we mentioned, financial markets hate uncertainty. And so we're seeing a lot of kind of volatility in the financial markets right now as a result of these conversations. And will they, won't they? And today we're going to do this tariff and tomorrow we're going to hold off. So is it a negotiating tactic? Are we actually going to put these tariffs on? These are questions that the financial markets want answered. And in the meantime, we're in for a lot of volatility while we're all working this out. One other point I wanted to make before I turn it over to Brad to talk about where we are in the markets. Not every company is affected the same by tariffs, right? So when you think about the companies that are importing a lot of goods, capital goods is probably the number one sector that's going to be affected by tariffs. And it makes sense, right? So, 30% of total imports in capital goods. The second is consumer goods. So all of us buying stuff from China. And the third is industrial supplies and materials, which makes sense. We hear a lot about cars. A lot of the automotive companies are doing things in Mexico now because it was part of NAFTA or USMTA or whatever we've renamed it. But cars, parts, and engines are a lot less impacted than these big categories of capital goods and consumer goods. So it's not going to hurt all companies equally. So with that in mind, Brad's going to chat about some market comments from a more general perspective now that we've laid the groundwork with what tariffs are doing.
Great, thanks, Anna. And please bear with me with my voice. So this chart shows the S&P 500 at inflection points, and so 324 2000. If we go back that far, during the dot-com bubble, the PE ratio, you see that boxed in chart in the upper left corner, was about 25.2. We had a pretty serious correction after that. 10/9 of 2007, before the Great Recession, the PE ratio wasn't and price earnings is the price of the S&P 500 divided by the earnings of the company within those 500 companies. So that's that 15.1 ratio. So it wasn't really that high then. We had went through the Great Recession of 2007, 2008. 2020 was another inflection point, and then moving all the way to the right would be 12/31/2024. And this isn't necessarily an inflection point. It's just showing you right now that the PE ratio is 21.5. The S&P is up 64% since this trough on October 12th, 2022. And so it's not necessarily, we have seen a little bit of inflection point here since February, mid-February, but the market does look fairly rich right now, or expensive, should I say. Next page will show you one standard deviation out. So on the 30-year average for the S&P 500 PE ratio is 16.9. So if you move to the far right, you see we're at that 21.5 level. So that's, a little over one standard deviation. So fairly expensive. The last time we saw it in that kind of level was before the 2022 kind of correction came through. And then going all the way over to the far left was that dot-com bubble, which was very different than we are now. But certainly the S&P looks fairly expensive. When it's expensive, typically the market will trade off to get it more to a normalized number, which we are seeing right now. On the next page, everyone talks about the Magnificent Seven. If you don't know who they are, they're at the bottom of the page. You probably know them by heart. They're Apple, Nvidia, Microsoft, Amazon, Google, Facebook, Tesla. And those are the stocks that have been really driving the market. So if you look in the top left, that kind of green, those top 10 stocks, have current PE ratio of 29.8, where the remaining stocks are 18.2. So they're very expensive right now. On the right side, you see the top 10 stocks make up 38.7% of the S&P 500. So it was a tremendous amount of concentration in those. Those are really the top. Those are the Mag 7 plus three more, which are Broadcom, another technology company, Berkshire Hathaway, Warren Buffett's company, and then JP Morgan. So those would be to round out the 10, adding those three. So if you look at all 10 of those, they all kind of sound techy, even though Amazon is really not really a technology company, but Tesla is not either. But they're all pretty racy companies. But there is a tremendous amount of concentration in the really top 10 names, highest is that we've seen probably in our lifetime. On the next page, it shows really the S&P 500, what's been driving its performance. As you can see in that upper left quadrant, in 2022, the S&P, both stocks and bonds lost money. So the S&P was down 19%. In 2023 and 2024, we've had over a 50% return. So it's been great. That blue is the S&P is not really the stocks, except for the Mag 7 have not done very well. They're up 8% and then 10%. And then the Mag 7 have just absolutely crushed it. They're up 76% in 2023 and 2024 up 48%. So, very unusual market driven by 7 mega cap stocks, all, the whole artificial intelligence and everything, a lot of things driving the market right now. They're unusual, but, we are seeing a correction in the Mag 7. We'll see if it's sustainable, but they have traded off quite a bit in the last 6 weeks. On the next page, once again, what hasn't worked in a while, we'll show you some more charts on this, is non-U.S. investing. Your portfolio, we like to have not quite a 50-50, more like a 70-30, 70% of the equities in U.S. stock and 30% non-U.S. stocks. But, what has not worked is investing outside the U.S. And, the U.S. has been up over 20% 2 years in a row, but non-U.S. stocks have all been up single digits. They've gotten really cheap. And, the U.S. is on the far right. You'll see now they're 67% of the world equity markets. So they've also, U.S. has become very dominant in the aggregate capitalization of the global markets. So other things that, you see things coming back into line where the U.S. doesn't become the driving country for equities. We're seeing that now. Some of the non-U.S. managers are up 7, 8, 9% in your portfolio, where the U.S. is, flat to slightly negative now. It's been a long time since non-U.S. investing has worked. But we don't know how to time those. Everyone talks about inflation. This is just the inflation chart. I mean, what's pay attention to is, excuse me, is those little gray bars, which are a recession. We had everyone had predicted a recession in the last 12 months. We haven't seen that. We'll see if we do. But core CPI has come down. The Fed wants to keep it around 3%. So inflation seems to be stabilizing. The Fed has never pulled off a perfect landing, but they seem to be doing a great job. We'll see. We still have some concerns going forward, but the Fed is actually pulling the strings quite well right now. On the next page, again showing the interest rates. Everyone's hope, actually, my wife and I are looking, we've been in the same house for 24 years, and so we're becoming empty nesters and downsizing. And, home interest or mortgages are 7% right now. We're fortunate to have a 3% mortgage right now. So everyone's hoping interest rates will come down, and, lower interest rates will drive home purchases, as well as companies, taking on more debt, doing more things to grow. And so, the Fed wants to get the interest rates down to stimulate the economy. Powell yesterday said they'll have at least 2 cuts this year. The market loved that, was up, 400 points. And so we'll see. The Fed's kind of in the driver's seat. They're a little bit at odds with Trump. So we'll see how that plays out. That would be one of the concerns. But right now, the Fed seems to be doing a very good job. And then finally, consumer confidence. On the far right, you'll see consumer confidence goes all over the place. And then on the far right, in June 2022, the world was kind of coming to an end. Bonds were losing money, stocks were losing money. And so consumer confidence troughed right there. You'll see it's not up to its average of about 84.5%, that blue horizontal line, the dotted one. But, consumer confidence is still not above average, but it's still, moving up, and it's it's very positive for the markets. People want to spend money, and that obviously drives stock returns.
Yep. Well, with that in mind, let's talk about how we have the portfolio positioned. So as Brad mentioned at the outset, both he and I come from the institutional world, and we tend to build all weather portfolios that should last over the long term, right? We want to make sure that your money is safe through the ups and the downs and market uncertainty and whatever the Fed is going to do next. So as you can see here, we have worked with Mike Tarrant and his team since August 2016, and these are the sum total of all of the changes we have made to the portfolio. So again, we are always watching the portfolio. We always have our hand on the wheel. We're focused on strategic long-term asset allocations that are going to work in a lot of different markets, and we're not going to be making tactical changes. So even though Brad and I are taking a look at things like concentration in the markets or what's going to happen with tariffs, we have really high quality investment managers who are managing your different asset classes, your US stocks, your international stocks, your bonds, that are really well positioned to manage the portfolio over a lot of different market environments. And one of the things that we always like to show is this page. So each of these boxes is one of the indices. So the yellow is bonds, the dark green is the S&P 500, just the growth stocks. And as you go from left to right, these are the calendar years from 2005 to 2024. And what we want you to see here is the box at the top was the best performing asset class that year. So in 2005, 6, 7, 9, 12, and 17, that was the MSCI emerging markets, countries like China, India, Brazil. But they don't win every time. And you can see here, there's a lot of years where they were at the very bottom. So you go from the very top in 2007 to the very bottom in 2008, to the top in 2009, to the bottom in 2011. There is not a lot of consistency to this pattern here on the page. And that is why we are not making a lot of calls. If you bet the farm on MSCI emerging markets in 2007 and you were wrong, you blew up a lot of portfolios that way. We don't ever want you guys to be in that position of going big into something that has worked really well right when it turns around. So because these patterns are so hard to find, that's why we have the approach that we do with a very steady institutional quality portfolio that's going to work no matter how these boxes bounce up and down. This is the portfolio positioning as of the end of last month, and it's also the same today. And you guys are probably very familiar with this because it is very similar to the way we've been managing money for several years. As Brad mentioned, we have a lot of overweight to United States equities, right? We're here in the US. It's been a good market. We've got a lot of the innovative tech companies and a lot of the companies that are really pushing the world forward. The US dollar has been very strong. For a lot of these reasons, we've got a big overweight to US. But we still do own international equity because, as Brad said, these trends are very hard to pinpoint, right? We don't know when these boxes are going to shift around. So we always have a weighting to international equity through a really high quality manager called MFS. They're up in Boston. We also own fixed income as a portfolio ballast, and these are very high quality managers. We are not taking a lot of risk in your bonds. They're there to help you guys when the equity markets go down. We want them to be very safe havens for your assets. With stocks and bonds, we wanted a third leg of the stool that's going to really help add kind of an extra stream of diversification. So every once in a while, stocks don't work and bonds don't work. And that's where we have real assets come in. So these are infrastructure, roads, toll bridges, publicly traded airports, and utility companies, power, water, things that are going to be kicking off dividends, are going to be used in a lot of different market environments. These stocks tend to hit signals and doubles. Right, so you're not getting any home runs in power companies, nor should you, right? As power consumers, we don't want that. But they are there to really be another way to protect against really big downturns and swings in the markets, especially with equity markets being so volatile. So those were the prepared comments that we had. So we're happy to address any questions that you guys have for us.
Thanks, Brad. Thanks, Anna. Yeah, if anyone out there in the audience has some questions, just unmute your mic and jump on in. We've got about 10 minutes of time, so we've got plenty of time for Q&A. So while we're waiting on folks to have that second sip of coffee and jump in, I wanted to, you brought up a good point, Anna, about the institutional flair of the management there and the way the fund and ETF selection works. I'd like the audience to know too that we really work on this as a partnership. So when Brad and Anna bring an idea to us, Charlie and I do our own research and due diligence, and then make the decision together about whether to add that position to the portfolio or to take a position out, and then pay attention to the tax impact for the non-qualified accounts too. So one great example is back on the other slide of the changes made over the years. Back in 2022, we brought the federated strategic dividend value idea to the team, and they researched it, saw that it was projected to add a little bit of value to the portfolio and take a little bit of risk off and beef up the income. So it goes both ways. We bring ideas to the team, they bring ideas to us, but the idea is to provide more consistent experience over time, to be risk aware and to avoid a lot of the ups and to avoid as 100% of the downs if we can. That's one of the primary considerations there. The one idea I just wanted to bring up, kind of circling back to your comments, Brad, about the S&P looking expensive, and you did address this a little bit. It doesn't appear to be all the companies in the index that are expensive. Maybe it is just really the top 7 or the top 10, but just we're kind of feels like we're going through a mini correction right now. Are you seeing that type of movement in the bottom 490 companies? What are you seeing there?
Yeah, they look fairly cheap, and so what a position we've had on since a long time, 5, 6, 7 years, is this position, this S&P 500 dividend ETF, which just buys. You can only buy within the S&P 500 those 500 stocks. And then it can only buy stocks that have been raising their dividend for the last 20 plus years. And so very consistent quality companies in that position has not done as well as S&P. Obviously, it doesn't have any really the Mag 7 in there, companies like Walmart, and
Mhm.
some of the healthcare companies. And it's finally perking up. It's up 2.4% year to date. The S&P down, 3.5%. And so, some of the stuff that you want to kick out of the portfolio last year, just gotta put your hands in your pockets and not hit the sell button. And it's the same with international things that are finally starting to protect the portfolio. There's a rotation into those names and into those countries, just like the MFS international fund that you all hold is up almost 10% year to date. So what a spread between the S&P down almost 4 and this up almost 10. So that kind of 14% spread in just 3.5 months. And so things that we've wanted to not get rid of, but just kind of tough to hold in this market with the Mag 7, which is very unusual. It's had 35 years, and it's what's neat about the market. Something weird happens all the time, and 7 stocks. That's all everybody wants to talk about. And I wasn't around for the Nifty 50, fortunately, but that it's right now some things that we've been holding are starting to work, so we're excited about that.
Yeah, it's kind of amazing how trends change and what everyone wants to run to when the switch gets flipped, everybody wants to run away from it. And I kind of get that because you're talking about your long-term financial security, right?
Yeah.
So it's interesting to pay attention to those trends and see how we can hopefully take advantage of that or see it taken advantage of within the portfolio. Anna, you brought up a point about tariffs, which I thought was pretty interesting too, that they can be product specific. Can you speak to kind of how people perceive tariffs in the media versus the reality of how they're applied?
Yeah, I mean, I think the media, look, there's not a lot of economists in the media, okay? So I think a lot of people have this perception that, we're going to start charging China, right? They're going to have to pay money, and China doesn't pay the money. So when you think about product-specific tariffs, I mean, the steel industry is always a great example for this, right? What we were trying to do was make sure that domestic companies could still produce steel in the US, right? It was a huge source of jobs. You've got the entire Rust Belt, but we could not produce steel at attractive prices anymore. So if we didn't use tariffs to increase artificially the cost of steel imports, we wouldn't have a steel industry, right? So, and you've seen this over and over again, a lot with the manufacturing. Because again, if you go over and you manufacture in China, we all know this, right? The labor is a lot cheaper. They don't have the regulatory overhang. I doubt they have anything like OSHA, right? There's a very different cost structure to manufacture in China. And there's areas where we simply can't be competitive. But everyone in the United States is not going to go to coding boot camp and go work for Facebook, right? So we do still need domestic manufacturing in certain areas. And that's one of the 3 arguments for tariffs. And, frankly, it's probably the most compelling one from a perspective of we actually are doing something that benefits the US in some way, right? So now we're looking more at the employees than as the consumers, but there are areas where tariffs have helped them.
Thanks, Anna. Appreciate that. I think Chris has a question. Chris, if you just want to unmute your mic and jump on in.
Yeah, thank you guys for presenting today. I just wanted to see if you could speak about bonds a little bit. I know as interest rates started going back up, they were really low for a long time, but so they went up, the bond, I guess the price went down. Everybody lost money in bonds and they're still not paying a lot. And if interest rates, who knows what they're going to do, but if they stay at 2 or 3%, will that price ever go back up? Will we recover those losses? What does the market look like for that going forwards?
Yeah, thanks for your question, Chris. So I actually just met with your bond managers the other day, and they had a great quote that the Hall of Fame for predicting interest rates is empty. So if you think about the Fed and interest rates, and we look at the Fed dot plot, okay, so this is the Federal Open Market Committee's year-end estimates. They are never right. And these are the people who are controlling interest rates. But the Fed is really only looking out 1 quarter at a time. Jerome Powell is running a very data-driven Fed, and they're looking in the rearview mirror at the last, couple months of data and making a decision that day. So I think there's a misperception in the markets, and financial professionals are guilty of this too, that they've got some sort of grand plan and they're forecasting out because we see this nice little dot plot. These are really just the individuals on there kind of guessing where things are going to go, but this has nothing to do with how they make decisions. So to that question, right, you're absolutely correct. So if you have high interest rates and those interest rates go down, so from the 70s to the 2000s, that is a really good environment for bonds. As rates go down, prices go up. And the inverse is also true, right? So we have low rates. If rates rise, which they have, that's bad for prices. You're exactly correct. Bonds are driven by interest rates, so that's one. They're also driven by credits. Okay, so how much of a risk are you getting paid to assume for buying Apple bonds or a small company's bonds over U.S. Treasuries, which are considered to be the safe benchmark? So that's another way that they're going to earn money in bonds, and we have managers that are really looking to do that. So what are our bond managers doing in this type of a market? They are moving the duration of the portfolio around. So if you think that interest rates are going to rise over the next 5 years, you want to own maybe the shorter part of maybe the next year or so, where your dot plots aren't going to change that much, right? So the Fed did not raise interest rates yesterday. We kept them steady. So you want to own a lot of the stuff in the area where you can predict, because you know that over the long term, you're probably going to have a negative price. You are also going to look for companies where you're going to get paid to take that credit risk, and you're going to be able to earn some money over and above what's happening with interest rates. So there's a couple different levers that they're pulling. It is very tempting to say, okay, well, interest rates are really low, they're going to go up, and we should sell bonds and just own equities. But the problem with that is bonds hold a very specific role in your portfolio, and that is to help you when the world gets bad. So 2008, bonds were the best asset class. 2011, bonds were the best asset class. 2018, 2022, this was one of those weird years where they were both down, but it was a lot better to be down 13 than 30. And so we still maintain those positions. We have very smart managers who are constantly watching the markets. But you're right that if interest rates do continue to go up, it's a structural headwind against bonds, and they've got to find other ways to kind of earn their keep in a portfolio.
Yeah, and to add that to that, the current yield on your bond managers is about 5.5%, which is actually pretty good.
Mm-hmm.
To the chart, we're showing the colorful chart. If that yellow box is at the top, that is not a good thing. That means nothing else in your portfolio is working. So you actually don't want the yellow box to be at the top. You want it to be at the bottom. So we'll hope this year. Right now, the bonds are up about 2.4%. The bond managers you're in, so they're beating the S&P by a pretty big margin. So it's kind of that yellow box would be kind of in the middle right now, which is kind of a Goldilocks a little bit environment, meaning that a lot of things are working in your portfolio. And so you got to be careful. You wish for bonds not working is usually not a very good sign, or it's actually a good sign. Is if they are working good, that means everything else is not working.
Yeah.
And so a yield of about 5 and change right now is really not bad, especially if you have it in a an IRA or something like that where you're not have to pay any taxes on it.
Mm-hmm.
Great point, y'all. Thank you so much. It's tough to watch mutual funds as an investor because we're not aware of what the manager's doing within the fund. It's almost like having your stew in the pot, but you can't watch it cook because the lid's on it. So all you can see is the steam. It's difficult. So we appreciate the question on that, Chris. If any of y'all have questions on any holdings in the portfolio like that, just either call us or shoot us an email. We're happy to dive deeper into what the specific managers are doing within their portfolios and how that might impact your investments. We are at the 8:40 mark. I want to be respectful of everyone's time. So thank you all for joining us this morning. We really appreciate it. Anna, Brad, thank you so much for your expertise and partnership with us and helping us build a slightly smoother ride for our clients. We really appreciate the partnership. Everybody have a really great day. Thanks.
Great day, everyone. Take care.
Thank you.
Bye-bye.